Hey everybody, JJ, Randy, and myself are back with a guest today to talk about multifamily syndication. We had a little bit of a faux pas last episode where we ended up screwing up our schedules ourselves. So now we have this conversation that we can talk about today. So we've got Ryan here. Ryan is going to talk about multifamily syndication, which for those of you that don't know, I'm actually going to let Ryan take it away. Ryan, why don't you tell us a little bit about yourself, your business, and what you do? I was going to start explaining. I was like, why am I explaining it? That doesn't do any good. Can you tell us a little bit about yourself, your business, and how it can help people?
Sure. Thanks, Ian. Yeah, happy to be on and happy to go over all the questions that you guys might have. So my name is Ryan Tennell. I'm with Top Producer Investment Capital, and we work with high net worth individuals, top performing realtors, loan officers, and investors who want to passively invest their money into all forms of real estate. We specifically do multifamily apartment complexes here in Texas, anything between 20 to 100 unit complexes. We'll buy them probably if they're needing some renovations, have a problem that we can fix, and then we'll buy them for a cheap price, upgrade them, improve the value of the property, cash flow them over a couple of years, and then eventually sell them. And then we split the profits with any investors along the way. So we have 7 properties here in Texas so far, 225 units. And, myself, I've been doing real estate for about 10 years. I started off as a loan officer, and then we've been doing this full time for coming up on 3 years here. So it's been a great journey.
Wow, JJ, he makes it sound easy. Do you think this is easy? Do you or Randy have any clients that have talked about syndication?
I do not. How about you, JJ?
I invested in 2 syndications, and I met Ryan from lending at CMG Financial.
Mm-hmm.
Yeah. Right? And this is the way I explain it to clients. It's the most passive way to invest in real estate, meaning you take a step back, you're not actively in the business, but it's also the riskiest because you're letting somebody take the reins on the investment.
Yeah, that part's nerve-wracking. JJ, would you do it again?
I think two apartment complexes were good enough for me.
Okay.
At the moment.
Mm-hmm.
It's good to have some hands-off experience, but it also gave me an opportunity to get my hands onto something.
Mm-hmm.
So,
well, I noticed you said something. You said it was the most passive method of real estate investing. Can you elaborate on that a little bit for people?
Ryan, won't you explain how this is passive? Like, how would somebody invest with you, and why does this work compared to like us buying our own fourplex and doing it ourselves?
Sure. Yeah. So as you mentioned, active real estate investing is you work with your realtor to identify an investment property, a house or a fourplex, and then you run a contract, you put your earnest money down, you do your inspections, you buy it, you hire a property manager or you manage it yourself and you put tenants in there and then you do any renovations. That's very active management. So syndications are the passive side of that, where we go off and we find the deal for you. So right now we don't have an opportunity for someone to invest in. So somebody wanted to give us money, they couldn't. But what we'll do is we'll go off and we'll find a deal and we'll say, hey, here's a 50 unit building. We're buying at 70 cents on the dollar. We need to raise $1 million for the down payment to purchase this. Who's interested? And we'll send out an email to everybody. We'll go over the benefits of why it's a good deal, and all you have to do is really evaluate if it's a good deal and if it's something you're looking for. Wire your money over to us. You'll be part of a bigger fund. So it's not only your money on the line, it's a lot of people collectively. And then we purchase the property with our earnest money. We do all the inspections, we do all the renovations, due diligence, we do all the management, we do everything. Typically these deals are held for anywhere in 2 to 5 years. And then at some point we'll sell it, and then you guys will get to split all the profits along with us as well. So really, it's completely mailbox money. Once you send it over, you don't do anything. We send out quarterly reports to tell you how your investment is doing. And every quarter, you also get distributions from the cash flow on the property, and those go ACH straight to your bank account. And so really, this is the least amount of effort you could do once you wire your money over. You just sit back and let the money come in.
Does the ROI really vary from project to project, or do you have sort of a consistent range that people could have in mind as to what this type of investment would do for them?
Yeah, so there's a few metrics that we use to evaluate if it's a deal worth doing. There's internal rate of return, average annual return, cash on cash, equity multiple. These are all kind of terms in investing that you can use as a reference. But the easiest one I like is just internal rate of return, which means compared to investing your money in the stock market or something that compounds annually, or putting in a certificate of deposit at the bank, what's the rate of return? So if you go to the bank, I mean, right now they're kind of high. It's about 4 to 5%. You can get at CDs at the bank. Stock market is typically 8 to 12%. We typically won't purchase an apartment complex unless we have confidence that we can get a limited partner, a passive investor, 15% of money on their money or more, which equates to being able to double their money about every 5 years. So,
wow.
And the reason we have that as our metric, not to say that every deal is going to get that, but we just won't buy it unless it's cheap enough that we have confidence we'll hit that number. So for instance, if a building is being sold for $6 million, we might bid $4.5 million, because at 4.5, after we do the upgrades, it'll eventually have a value of maybe 8 or 9. We feel confident that that's the amount of profit that we get. So we won't buy it unless we can do that $4.5 million number. So that's why we do the underwriting, and we feel good about the final returns.
And it was interesting to hear you say doubling every 5 years. So how long is somebody going to be involved in one project, would you say?
So typically these projects take anywhere between 2 to 5 years. We have one project that's a very long-term hold. It might be 10 to 20 years, but that's more of an ongoing cash flow play. But typically we'll buy a property, and it takes about 18 to 24 months to completely renovate every unit and all the exteriors. So depending on market conditions, my investing philosophy is just whatever the highest rate of return is, get it back to the investor. So usually that means selling the property once you finish renovations and you finish flipping it. So that could be in 2 to 3 years. But right now, with where we are in the economy, we're holding things a little bit longer to allow them to cash flow. So certain properties might end up being, a 4 or 5 or a 6 year hold, just depending on where we are in the market cycle.
So getting involved in multifamily syndication can actually be both roads of the short-term investment, where it's more of a flip, but also the long-term road, just depending on the market conditions, whenever you're going to hold and do, I guess, rental collection. Is that correct?
Yeah, I'd say so. I mean, if you flip a house, depending on how much work, it could be, 3 to 9 months. Whereas apartments, I'd say the shortest flip that you can do is, 6 months if you don't do any renovations, but probably closer to that 2-year mark for a flip on an apartment complex.
What's the barrier to entry? If you can even, quote a number like that for somebody that would be wanting to consider, what kind of funds should they have to play?
Sure. So typically we work with accredited investors, and there's 2 ways that you can become accredited. Either your net worth is $1 million or more, or you've earned at least $200,000 a year in income for the past 2 years, and you're on track to do that in the future. There's a few other ways, but those are the main 2 ways. So our minimum investment into any of these deals is $50,000. We do allow some investors that are not accredited, but usually a good rule of thumb is you don't want to invest more than 10% of your net worth into any of these deals. So if your net worth is $500,000, that would be the minimum to invest the $50,000 into one of these deals.
Okay. I think I've asked you so many questions. Sorry, I'll pass the mic off to somebody else.
A beautiful series of questions. Every question was exactly on point. I just wanted to give a shout out to Matt Tiefke, he owns a large brokerage in the Austin area. So, hey, Matt, thanks for watching our show. And yes, Ryan's bringing the fire today. And Christina, she works for a championship title, and she's here just kind of dropping by, saying hi, thanking us. We appreciate you. Thank you both for watching and chiming in. Ask Ryan some questions. You're not asking us. Ask Ryan some questions. So I guess one of the questions I have, there are a lot of things. You said a lot of stuff in there. One of them was, you said you don't have anything to invest in today. So let's say someone came to you and said, hey, I've got $50,000. I'm an accredited investor, and I want to get started. Can you take them from that conversation to getting a group of people together to moving forward with finding a project?
Sure. So usually our process is, if an investor is interested and either they're accredited or not, but we've had a conversation about their finances and they've got $50,000 or more to invest, we'll put them on our investor distribution list. So I don't have a deal right now, but probably in the spring. We try to do 2 to 4 deals a year. So probably in the spring, I'll send out an email once we get something under contract and we say, hey, here's the next investment deal. Here's the next opportunity. We'll have a full packet available in 2 to 4 weeks. We'll do an online webinar where anybody can attend. So just if you've got the money right now and you know this is what you want to do, just kind of hang tight. We'd rather be patient and find a really good deal than just buy whatever's out there right now. So we're going to search. We probably underwrite and make offers on 100 properties before we actually get one under contract that makes sense, just because we'd rather find a really good deal going early. So yeah, if somebody's ready, they just kind of have to wait until we find one.
About how long do you think sometimes people can end up waiting until it actually goes somewhere for them? Can it take up to a year, more than a year?
Sure. I mean, we try to do 2 to 4 deals a year. So probably, every, 3 to 6 months, we'll have something we can send out. Okay. So they won't have to wait too long. This year is a very interesting market cycle. We've only done 1 deal this year. Last year, we ended up doing 5 deals. So it just kind of depends on where we are in the market. But yeah, generally, they won't have to wait too long. More than, 6 months would be unusual. Can
the market kind of turn against you and it can get very competitive and very tough to make deals happen? We're not really in that space right now, I would assume, or maybe I'm wrong on that.
It's pretty difficult right now. A lot of the interest rates are, in multifamily between, 6.5% to 8% if you're purchasing a property. If you guys are familiar with cap rates as a term, those have been increasing quite a bit, which means values have been coming down in the commercial space. And if you're a person that owns a building that's got a locked in 3 or 4% interest rate, you're not very motivated to sell it for less than you think the value's worth, because these are all cash flowing assets. So if you're owning a property that's, paying off your mortgage expenses and a profit to yourself and your investors, and you don't want to sell it right now, you don't really have to. Now, the difference between commercial and residential is most of these commercial loans have balloon payments, either 5, 7, 10 years down the line. So even if they don't want to sell right now, at some point, the bank will probably have a balloon payment that they either need to refinance or sell or do something. The reason we're having a difficulty in the finance right now is a lot of people purchase things on bridge loans, which had balloon payments 3 to 5 years out. And if they bought them, at the peak of the market a couple of years ago, they might have a balloon payment coming due. And if they were going to refinance their loan to extend to a new 5-year term, if their value of their property has dropped according to the bank and they're not making as much as they thought, they might either have to bring $1 or $2 million as a cash in refinance to be able to own this property, or kind of have to sell it. So I think a lot of operators are having that difficult conversation with their investors of, do we have everybody contribute more money, or do we just sell the property and take a little less profit than we are expecting right now? But on the purchase side, that's where opportunity is. If you can get something right now that's 30% less than it was a year ago, I mean, it's a good time to buy.
Yeah, how interesting that you have to experience both sides of that at the same moment. Interesting.
Yeah, we've been fortunate. A majority of the loans that we have done have been through smaller community banks. Typically, if you do deals that are between $1 and $10 million, community banks are a good option. Usually their terms are flexible, but their interest rates are between 0.5% and 1% higher. But the balloon payments that we have with most of these are, pretty extended. We have a 7-year, a 10-year, a 15-year, and a 30-year balloon. So most of the community banks will not do prepayment penalties, not do as difficult balloon payments, but in exchange for a higher interest rate up front.
So I'm going to ask you a question about taxes. 1 second. So Jeremy, I just want to give a shout out to Jeremy. Jeremy and I run a podcast called Real Migos for Austin. Thanks, Jeremy. I think he's talking about the airport in the background. That's what it is. He's talking about the airport. So I know that multifamily syndication is a really good option for people if they want to defer their tax burden, I guess is a way to say it. Maybe there's a better way for you to say it. Can you talk a little bit about that? I think that's a big interest for a lot of people, especially after the rise and fall of the last couple of years.
Definitely. Yeah. Doing commercial syndications or any kind of real estate investing can have tremendous tax benefits. I didn't pay any taxes last year. I won't pay any taxes again this year and probably for the next few years because of this vehicle. Now, at some point those will come due. So I'll kind of explain the method that we use. So it's available whether you do residential or commercial investments. Doesn't necessarily have to be a syndication, but we use cost segregation studies on every property that we buy. Now, the price to do one of these studies can be expensive, usually between $4,000 to $6,000 per property. So on the residential side, even if you get tax benefits from this, paying $4,000 for this study might outweigh the benefit that you would get from this tax side. But on the commercial side, when we have $150,000 of closing costs on these deals, another $4,000 really doesn't move the needle much. But with these cost segregation studies, they take the entire depreciation of the building and they front load a lot of it. Normally, when you purchase a house or any kind of building, you would be able to depreciate the asset over 27 and a half years, which means you can write off about 3% of the value every single year on your tax returns if it's an investment property. What a cost segregation study is, they'll have a CPA go out to the property and they'll say, well, this has a roof that has this much value. These have countertops with this much value, a driveway with this much value, and they'll break it into its pieces. And they say a roof depreciates over 15 years, driveway over 10 years, refrigerator over 5 years. And then they have this thing called bonus depreciation, which accelerates a lot of that. So you can have all of that depreciation basically get 80% higher this year. Last year was 100%. Now it's 80% higher. And it's, I don't know why it's legal. It just seems like a loophole to allow people in real estate to continue to invest more in real estate. There is a lot of incentives to come in real estate. We do have a lot of jobs. We're hiring leasing agents, property managers, providing housing, hiring plumbers, electricians. So it does spur a lot of economic activity, which is kind of why they do this. But, the big question at the end of the day is, these are all a lot of numbers, but, how much am I actually going to save on these taxes? So with our syndications, typically, if somebody comes in, we can have them write off, between 30 to 50% of their investment as depreciation that first year.
Wow.
So, for instance, if someone were to come and let's say I had a deal and, we had one that did 35% earlier this year. So if someone put in $100,000, they would get a $35,000 write-off as depreciation this year. Now there's two categories. So for the average investor, this would be a passive loss. So it would offset capital gains or dividend income or cash flow income from your real estate, but it would not offset your ordinary income, your business income, or your W-2 income. The one exception is if you're a real estate professional. And again, you have to kind of talk to your CPA about which classification you go into, talk to your CPA about all of this, because I'm not a tax professional, but if you do fall into that category, it can go against your active income. I personally am a real estate professional, and that's why I can offset all of my ordinary income and not have to, or at least defer my taxes until we sell these properties later down the line. But even when we do sell, I plan to do 1031 exchanges and keep passing that further and further along. Eventually, you can put all of this into a trust, name yourself, your heirs, and your loved one as beneficiaries. If I pass away, then that basis gets reset. So there's a lot of strategies that you can do to delay and hopefully eliminate the tax long term.
You're a real estate professional and not a CPA, because that is a lot of awesome information. So that's really killer.
Just
sure, I've studied it a lot. I love the benefits of not having to pay tax, or at least deferring it. So I try to study it, and we heavily lean on our CPAs and cost segregation experts to get all this information.
Yeah.
So just like Jeremy said, I wanted to thank you for putting this together, JJ, for the connection. This is a really good conversation. One of the questions I would have is, so we know that you're not a tax planning professional. However, it sounds like you will A, do this, but B, probably teach this. Is that a fair assumption or no?
Definitely to have the CPA license, comes with a lot of it. All I can do is give you guys my experience, my opinions, and say, kind of talk to a CPA. But hopefully conversations just like these open people's eyes to the possibilities of what real estate investing can do, whether they do that actively with their realtors and their own properties and get the same benefits on their own, or they want to come into syndications and just get them passively. So hopefully it spurs on a conversation with their own CPA.
Right.
How long have you been doing this? And I'm sorry if you already mentioned that at the beginning.
Sure. So I've been in real estate 10 years full time. I started off as a loan officer, and we helped 600 families get financing for their loans. I bought my first personal investment property back in 2016, kept buying properties every year, and then eventually, started doing multifamily apartments about 3 years ago full time when I quit my job as a loan officer just to do this.
Regarding asset class, Because there's syndicators that also do like retail strips or like medical office as well. Is there a reason that apartments that you went that direction, or are they more popular, or are they more popular with realtors because we're really close to multifamily?
Sure. Yeah. I understand multifamily because I was a tenant myself. And so I get where they come from. But yeah, there's syndications. Syndication is just a term that means pooling investor money to do a venture. That could be investing in your friend's restaurant business or investing in the stock market or doing real estate deals. As far as commercial asset classes, multifamily is a good one. There's also retail strip centers, like you said. There's industrial warehouses. There's office spaces. There's mobile home parks. There's all kind of stuff. We're actually running a boutique hotel out in Canyon Lake, which is kind of where I am right now.
Right.
But yeah, between all of those, they each have their risks and rewards. Multifamily apartments are nice because everyone needs a place to live. They're pretty predictable. People sign 12-month leases, and there are evictions and there is maintenance, but you can pretty much determine a value pretty straightforwardly with where multifamily is at any given rate, because you'll have a consistent base of tenants paying you rent consistently. Retail, like strip centers, they're going to be more consistent. These people sign 5-year leases, but they trade at higher cap rates. They have lower building values. And a lot of times you can have a building sit vacant for a year, 2 years before somebody actually signs a lease and move in. So you've got to have a lot more reserve capital to be able to sustain that. But once you do get someone in there, it can last a long time. Industrial warehouse spaces are getting very popular. I actually have a partner who's looking into developing a few of those. Those are good for if you're going to have, a lawn care business or a plumber or a gardener that just needs to put their stuff somewhere, an auto mechanic that just needs a shop to kind of work out of and store their supplies. Same kind of deal, though. They can sit vacant for a long time, but once they are filled, they're typically, 5-year leases. So they're pretty stable.
Are all of your tenants long-term, or have all of your tenants in the past been long-term, or have you dabbled in STR within multifamily syndication? Is that a thing that you've done?
Yeah, we have one short-term rental community, and it's very seasonal. So the summer was great. It was a high season. We had a lot of people coming in here, and we're still under construction, kind of developing it and making it get even better. So we're excited to see what next year brings. But we only have that one property. A majority of all of our other properties, I'd say 200 of the 225 units that we have are long-term rentals. So we have 12-month leases with each of those.
Say 12-year leases. How did you pull that one? Wow. Escalation clause. If that's a thing for a lease like that, you could.
We do. Yeah, I have a couple people that they, ask us, hey, what's the way we can get a little discount on our rent? And I'll say, we'll give you $25 a month off if you sign a 2-year lease. And sometimes people do it because I'd rather have consistency than just the highest price.
What city got the nod from you to do the short-term rental project?
So we're out in Canyon Lake right now. And it's funny, actually, I remember Canyon Lake is an hour southwest of Austin. It's not actually a city, I figured out. It's just the name of the lake and the kind of area around it. It's in Comal County, but there's not actually a city governing it. So that helped us in deciding to go with the short-term rental community, partly because it's a vacation destination. People come out here to float the river, go to, Worst Fest right now in New Braunfels, and actually hang out in Canyon Lake. They do sailboat racing and all kinds of stuff. But there's no, really zoning or building restrictions where we are. So we can build whatever we want. No HOA. So there's no one to tell us whether we can or can't do short-term rentals out here. Now that could change, cities and counties can change the rules at any point, but for now we feel pretty good about it. And there's a big market for it out here. So we felt pretty safe with going this direction.
That's interesting about Canyon Lake not being a city. I've never put that together, but you're right. There is no city out there called Canyon Lake. It's
yeah, I'm with you.
I didn't know.
But up against New Braunfels, but you are also right in that the lake, it's kind of offset, but it's not too far from 35. So if you're traveling between Austin and San Antonio, it's kind of right there. Mm-hmm. And it's a really cool spot, kind of exclusive. I think it's growing a lot right now, which is, something to think about. But I see a lot of potential out there, at least for the next few years. Sorry for the tangent. I think I just realized what he's talking about. I think he's talking about my shirt.
That's what I was thinking. Why?
I was like, what is he? Why would he say fly? People haven't used that since a long time ago. Okay. Got it, Jeremy. Sorry. Sorry, Siri's talk. Oh my gosh. Okay, so one of the questions that I would have, and I think most people would have, is let's say one of my clients we have a really good relationship already, but I want to connect them with you so that they can grow their investment portfolio just in case the single family life might not be for them. How does our relationship, so for any realtors listening, how does our relationship work?
Yeah, typically we work very well with realtors in that, hey, if there's some clients that want to buy their own personal house as a primary residence, vacation home, or their own investment properties and actively do investing from that direction, work with your realtor, make sure that they're helping you find a good property, find where there's going to be appreciation in the area, find something that cash flows well, and the risk tolerance is what you're looking for. That's something where you work with your realtor to find those. And if you get to the point where you've got $1 million in the bank and you say, hey, I've done all that, I want to focus my time on growing my main business, or I just want to retire and I don't want to get my hands dirty with working with contractors, property managers, and I want to be hands off. That's when we're typically stepping in with higher net worth individuals that don't want to do anything. But if somebody wants to be active and they want to, have a hands-on approach, work with your realtor and make sure that you're getting the risk tolerance and professional guidance that you need from them.
So I'm going to throw an example out there. I have a friend, she had something like 20 single family residences in Austin. And it seems like one of those situations where as she's sunsetting her career, it would be a really great opportunity for her to just sell all those properties and then give that chunk to you so that she can have a passive cash flow. Yeah.
Yeah, there's lots of options for how to partner up on deals. So syndication is a method where they just sell all their properties and pay money to us. We've done joint ventures as well, where we'll say, hey, let's buy 50% interest in the building so that you can retain some ownership and get some benefit from that. But then we'll step in as the operator and we'll do all the work. And then you're still passive at that point. We've also done joint ventures where instead of somebody contributing, one piece of the puzzle, they come in and they're also an operator along with us, but they contribute larger chunks of money in the deal. So there's lots of ways that you can be semi-active or diversified in your investing instead of just one chunk. But I'd say, yeah, typically, 90% of our clients just don't want anything to do with it. They say, hey, I have a business that I run day to day. I'm pretty busy. I just want you guys to handle all of it. Keep it pretty simple and straightforward.
I really like that operator model.
Yeah. An operator and syndicator are synonymous, right?
Yeah.
The syndicator and the operator are both running the show.
Same term. The operator is the one, going out there and doing the active work on the buildings.
So let's say we had a client, they had 50,000, 75,000, 100,000, and they wanted to invest in it. And they would say something like, well, the stock market is historically at 10%. How do I know that this apartment complex is 15? You said 15% IRR, roughly.
Sure. Yeah. Are you asking like, how do we know that it's going to get those returns, or how does it compare to the stock market?
Yeah. How would you explain that to an investor? Tell your realtors to open this up as an option.
Sure. So the stock market's typically pretty consistent. It's been a little volatile the last few years, so it just kind of depends on your risk level and your understanding of the stock in general. If you want to be diversified, do the S&P 500 mutual funds. That's a pretty good way to go, pretty consistent. If you want to individually pick stocks based on your knowledge of investing in those companies, you can definitely do that and try to beat the market. But I would say the stock market benefit is it's very liquid. So if you put your money in, tomorrow you can take it all back out. Our deals are a lot longer term. So if you put your money in, it's up to us to fulfill your promise to get them all to cash flow and profit, but it's going to be in there for 2 to 5 years. And kind of exchange for that, we have higher return metrics. And the reason we feel confident about those return metrics is that markets kind of come and go in cycles. So we were on, 7, 8, 9, 10 years of the real estate prices going up in Austin. The last 1 or 2 years we're here having a shift, but more than likely at some point they'll go on a longer term trajectory up again. Rent prices are pretty consistent. Even though they do go up and down, there's pretty rarely is there a flash crash where a rent price will get cut in half, from 1 week to the next, when the stock market can have those quick fluctuations. And typically because these are 12-month leases, these are longer term cycles. So they're very predictable. We know where the income is going to come. We know where the cash flow is, usually within, 10 or 20% of total profit, total distribution. So when we say, hey, it's going to be a 15% return on your money. Well, could be a little lower if the market goes down to like maybe 10 to 15. But on the higher end, we've had deals that have gone up to, 25% if the market's performed exceptionally well. So it's kind of the same as the stock market. We're just, we're on the higher tier end in exchange for having longer term duration before you can pull your money back out.
So not as liquid, but you're getting that higher return.
Absolutely. Yeah.
And what should an investor, what's up, Ian?
I was going to say, he keeps dropping these terms that just aren't in everyday real estate conversation, like single family conversation, like flash crash. I was like, oh, what are you, an options trader? Like, it's just funny that you say that because, again, it's just, I can't remember ever using that in a statement with clients on a regular basis. So one of the questions I was going to ask is, are all of the properties that you have or have had, are they all local or fairly local, or do you have stuff that are out of state?
Yeah, everything I own is here in Texas. We have a property in Dallas. We have 2 in Austin. We have 1 in San Antonio, and the other 2 are in Canyon Lake, Gonzales, so kind of small. And I like Texas. I grew up in Dallas. I've lived in Austin 10 years, so I understand how the dynamics, how the markets are here. I can drive to the properties at any point. I can check in on them and make sure they're doing well, make suggestions. Anything that we're going to buy, I can check out the area. And, the longer you're in an area, the better you get relationships with local brokers, local investors, local property managers, local vendors to help. So the system can really grow and strengthen with economies of scale if you stay in the same region. I've been asked to do deals out of state, and there's different tax laws, there's different insurance laws, there's different tenant right laws on how fast you can do evictions or what you're allowed and not allowed to do. So rather than make complexity out of all that, there's plenty of real estate to go around in Texas, and it's a growing market. People are moving here. I'd rather just stick to what I know.
Right.
What's your favorite city in Texas to do this in if you had to pick one?
Canyon Lake.
They're all very different. I've been surprised. Austin has gone down in value the most in the last year, whereas Dallas and Fort Worth have been very consistent. Even though, the interest rates have gone up, the percent decline in Dallas has been, I don't know the exact number, but, in the single digits, where I think Austin's been in the double digits, 10 to 20%, depending on, what property, what area, and all that. So I've liked the consistency of Dallas as much as I love fluctuations, that if you buy really low and it goes really high, that's when you make the most money. I'd rather just have something predictable and stable. So Dallas has been great. And it's a much more, it has a lot more history. It's a larger city. There's a lot more complexity to it. So you can have, a property over there is going to have staying power a lot easier than Austin, which is changing and developing so much. The property I have in San Antonio is doing well. There's the economy over there has a lot more workforce. And so you get a different class of tenant that are typically moving into those buildings. And so you have just, you can typically make more money and a higher cash flow, but it takes a little more hands on deck to deal with broken leases, late payments, or people that, have difficulty in qualifying for leases. So it's just, each city's a little bit different, but I'd say Dallas has my eye right now as far as it's been predictable and it's growing and it seems pretty stable.
Can I ask you two political questions? Semi-political. I don't want to get all political, but hold on.
Early voting today, by the way.
Well, that was what I was going to say. So there's early voting, but so let's stick on that subject. Because there's voting today, is there anything that's on the ballot for the Texas State Amendment? I don't think there is, but I'd like you to answer this. That will impact your clients or your investors.
Yeah, it's a good question. I should be more aware of what's going on at the local, and even state level of like these jurisdictions. I know tax has been a big item on the ballot, recently, that property taxes have just skyrocketed, both in value and the percent that these districts are charging. I know there's been a lot of work to help get those lowered. I want to say that from here on, there's been some success in that governments have saying they're going to get them lowered over the next year. So we'll kind of see what's going on there. I wish I was just more aware of the other topics that are on the ballots. I know anytime there's an election year, a lot of the presidents make claims about how they're going to improve the economy, how they're going to stimulate people, how they're going to bring back jobs. Typically, those promises end up being pretty helpful to boost the economy. So that could come as interest rates coming down. That could come as stimulus programs to help boost workforce so that they can afford more rent. So during an election year, we usually see benefit in real estate, or at least that's my opinion or my expectation for the next 2 years.
One of the big things on the ballot is the homestead exemption, right? Increasing the credit or the exemption itself. So I think that's a big one. So the next question, this is semi-political. Sorry. That was a great answer, by the way. Does what's going on with the National Association of Realtors have any bearing at all in your direct business? I don't know that it would, but just want to ask the question.
Yeah, you might have to inform me on what is going on with the National Association of Realtors.
Probably
if you don't know, then it doesn't. I don't think it does.
Regarding the political stance, I think if you do enough research, there's probably a party that's more beneficial for like bigger apartment complex investing and tax loopholes. If you were to do your research, I'm pretty sure.
What?
Wait, are you saying no?
Maybe.
That's so funny. One of the things on the ballot was so silly. It was increasing the retirement age of elected officials.
Mm-hmm.
And I was like, everybody's already so old. Why would you do that?
No, I'm with you on that, Ian, for real. Let's bring that down. So.
What are the arguments for and against again? I want to make sure that I'm sure.
There was this clip of Warren Buffett one time where he was saying, the national debt's getting really high and congressional spending is getting really high, and it's hard to keep monetary policy in check. Like, how do we really do that? And his comment was, well, you could say unless the budget gets rectified and we decrease spending next year, everyone currently sitting in office cannot be reelected unless we're in the right trajectory. He said we would fix that policy really quick if the incentives were aligned that you had to fix it in order to stay in office.
Oh, that's good.
Good point.
He's a smart man, even though he is very old.
Some money.
He's still very smart.
He's also very
intelligent.
He is.
But I mean, he's created this success story that I think a lot of us would maybe not like to emulate exactly, but are inspired by.
Speaking
of
JJ, Buffett, what's up?
No, I was gonna ask if you had anything in particular, like back on track. But what were you gonna say about Warren Buffett?
Well, Warren Buffett, I've watched a documentary. I think it's like Becoming Warren Buffett or something like that. It's a HBO. It's a few years old, but it's an awesome documentary. It's an HBO documentary. It's free on YouTube. But he essentially started by pulling money together because he didn't have a lot of money, but he put together
syndicate.
Kind of syndicated.
Mm-hmm.
So I thought
still a segue to getting back on track.
Yeah.
I was gonna say, I like that you said it's free on YouTube, but it was on Netflix, which means it probably shouldn't be free on YouTube.
It's free on YouTube. It's HBO streaming.
That even less so then, right? Somebody put it up there and wasn't
about to get taken down because of the podcast. But what's interesting is, okay,
I know. Come on.
I say it's a passive investment, but at the same time, if you're about to passively invest, I don't think anything's like truly passive, because you could hear by the conversations, you're going to have to actively, at least a little bit, figure out whether you're going to do an apartment complex or an office building, or if it's Ryan's apartment complex syndication.
Well,
I'm curious.
You could just hand Ryan money and not do the work.
You could.
Yeah.
You could, because that's an option. But if you're to increase your passive / active activity, like what kind of questions would you expect like an investor to ask you, or how would you differentiate yourself from another apartment syndicator?
Yeah. Oh, that's a good question. I have another question for you after that. I was just kind of thinking about the residential space and what you guys are seeing out there. But as far as the difference between us and other investors and syndicators out there, transparency and track record and reputation are really the main things that you have to go off of, because anybody can put together a business plan or prospectus that says you're going to make 10 times your money in the next 1 year.
Right.
But it comes down to, okay, well, have you proven to be able to do that in the past? and what data can you show us about this particular investment to say why you believe it's a good deal, instead of just saying, oh, it's in a great area and there's a lot of potential for growth. Well, okay, but yeah, what data? Like, how much has the population grown up in that area in the last 1 or 2 or 5 years? How much has the average household income increased in the last 5 years? And then for this particular property, well, currently you're getting rents for 50 units at $900 a month. What are the comparable properties renting for in the area that were built, around the same year that are about the same square footage? If you think, hey, on average, if we increase, the amenities to kind of look like the comparables with, stainless steel appliances, quartz countertops, luxury vinyl plank flooring, what do we got? Brushed nickel finishes. We do all those, cost us about $10,000 a unit. And we can show that that'll take us from rents at $900 a month up to $1,200 a month. Well, that's what at least the comparables are doing. Multiply that 50 units times 12 months a year. You can see what the potential increase in the value is going to be. So someone that has all those data sources that can point to them and say, this isn't just about feeling. This isn't just about, I like this paint color, or I like this, new chandelier we're putting in. But they have really data that they can say, here is the reason why we understand that, even if we're wrong, or even conservatively, if the market doesn't do well, we should hit at least these numbers. That's how you can tell if somebody has done their homework. And of course, reputation, references, previous deals that they've closed, they have actually made the profit that they said they were going to make. Those are all the things that I would say, okay, this is what differentiates one syndicator from another one. There's a lot of gurus and coaches that are telling people this business is easy, that all you got to do is, call your mom and friends and a couple of people and put some money together and you can buy a building at any price and it's just going to work out. Well, there's a lot of people that are having difficulty right now with adjustable rate mortgages that have gone from 3% up to 7% that are in a bit of hot water. And so people that got in thinking it's easy or not doing their homework or research are having some trouble right now.
Oh, man.
That's so crazy. When you said that, I was thinking, you know what? Syndicators and wholesalers are like what realtors were in 2019, where or 2020, where they're just coming out of everywhere. Like they're just everywhere you look, there's a new one. And so I've been seeing that a lot with syndicators and wholesalers specifically in the last few months. Have you noticed that? Have you noticed that kind of trend?
Yeah, absolutely. So there's a lot more syndicators, and then there's a lot more coaches and educators teaching syndicators, and then those coaches generate more and more syndicators out there. And it's a big network and it's a big community, but there's a lot of people who have been doing this, less than 5 years. I mean, myself included. I guess one of the differences is I put my money, I put $50,000 into every deal that I do. So, when we do the general partnership, the operators, we're the last ones to get paid. And I really want to get paid, so I'm going to make sure everybody else gets paid first. And yeah, I think that's kind of what separates is like, hey, that experience, that track record, and the homework and the due diligence to say, where did we get our data?
I think that's a big question. A lot of people ask, well, if you are a realtor and you are selling homes in an area, do you actually own a home in an area? And it's kind of the same thing here. If you're selling a service to work as an operator, as a syndicator or syndicate, then are you also investing in that same thing on your end? So it's great to hear that you are. I like that.
Yeah, I would say you'd have to have a really good reason why you are not putting your money into a deal that you think other people should put their money into. So I if it's a good deal, it's good enough for me to put my money into.
That's funny.
Yeah,
Someone asked me that today about my own ownership and where my money is.
Yeah. I have a question for you guys as, on the residential side of things, the deals that we're seeing that pencil either have taken such a huge price decline because somebody has to sell because their balloon payment is coming up. But a majority of the ones that are selling usually have loans that are assumable, or they're doing creative finance deals. Like the most recent one we purchased, we did a seller financing arrangement because the owners owned the building free and clear. And so they were able to give us a seller financing note, but we pay them just directly. So I'm curious on the residential side, are you guys seeing more of those creative finance options surface up for investors that are looking to do deals in that way? Or what are you guys, seeing as the solution to some of these higher interest rates?
I'm seeing more like buy down points,
Mm.
some assumable loans, but more so I see a lot of sellers kind of sticking to their old interest rate, their old low interest rate, and they can't make that decision whether, if they don't have a very motivating reason to sell, they're kind of sitting, or they're still associating with a higher inflated price or potentially inflated price. What are you seeing, Ian?
Well, same thing. If either if the motivation is high enough or the opportunity cost is low enough, I guess is the other way around, right? Like if there's just, it's a no-brainer because they can get everything they want and they have the resources to be able to do that, then I'm seeing that. What I am getting, though, going back to the wholesalers, investors, and that sort of thing, I'm having a lot more people reach out asking me for that service. Hey, can you find me some seller financing? Can you find me someone who's willing to do an assumable? I'm not a VA. I need you to do this. So I have a lot of those inquiries right now.
I think you had a good point, JJ, where there's a lot of activity with interest rate buy downs. I've seen that, or I've read news articles, especially from new home builders. So something that kind of has my attention is, if let's say you're a new home builder and interest rates are really high and you really need to sell these homes, but they're not selling for $600,000. So you could either drop the price down to $550,000, or you could spend that $50,000 to do an interest rate buy down and buy it down from 7 to 5.5% or something like that. So the payment ends up being the same, right, for the buyer. But when you do the interest rate buy down, the comparable price is still $600,000. So a lot of these homes really might be in that 550 range, but because they're structuring it as a buy down to keep the comparable prices high, builders are kind of, it's hard to tell where the prices really are right now, or at least there could be a time in the future when that shifts very quickly. So I don't know if you guys have opinions on buy downs versus, builders just decreasing the sales price but not doing a buy down.
Yeah, to me, it feels like the Wizard of Oz behind the green curtain. They're doing. So that's what that crap feels like. And then they just put the cost to the buyer and the closing costs most of the time anyway, which is also very frustrating.
Mm-hmm.
So it looks great up front, and then you dig in and get pre-approved, and then the closing costs are $20,000, $15,000, $20,000.
So I actually did a post on this recently on LinkedIn and Facebook. It's a couple pages, but I do this calculation. I used to be a loan officer, and so when people do interest rate buy downs, usually it takes about 4 years for you to have saved enough money from the lower interest rate to have paid back the money that you paid up front in closing costs. That's just a break even. You probably need another 4 years to make a profit from that, over that time. And, that means, okay, so between now and the next 8 years, our interest rate's probably going to be higher, lower, or the same than where they are today. Well, if you think they're going to be lower, it makes sense to be at a higher interest rate with a cheaper house and then refinance it in whatever year that is. And then you kind of get the best of both worlds, because you can't change the price you pay for the house, but you can change your interest rate later.
Yeah.
That's a good point.
Yeah, I think another part of that is just the narrative that you hear all over is interest rates are so high, and so people are fixated on that. But yeah, I think the builders are putting us in a situation because we have so many homes that are new construction. So
well, it's easy to say, hey, the housing market's doing okay right now because comps are really high, but you never see anything about the buy downs, unless you read everybody's closing statement, but that's not really public knowledge.
Well, we see them in the MLS, but right, it's not transparent to the end user or to the consumer.
Well, the builders they just sell behind the scenes. So
oh yeah, some of them do. Some of them are transparent. They'll list it. They'll share if they did closing costs. Some of them will. Most of them, you're right. They'll keep that private between themselves.
So something that's interesting as well on the residential side with the MLS, you guys have a lot more access to information. On the commercial side, in Texas, it's not public. So, there's CoStar, which, has some access to public data, and they call a lot of owners and they just ask them, would you tell us what you paid for the property? Would you tell us what your current rents are? But, unless it's written on your loan documents or your deed of trust, it's public record, you're kind of guessing at what the prices of these are. So you have to rely on a lot of commercial brokers and a lot of other owners to see what these prices actually are. So it's a lot harder to run sales comp numbers in the commercial world, or at least there's a lot more, data on the residential side. So that was a learning curve, is getting into this, is saying, not only, it's hard to predict the future sales price or even the current sales price. So you have to go on what that you can operate, what your expenses are, and where you see rental comps are for cash flow. as a more important driver for whether it's a good investment or not.
That is so interesting. I actually just had that very quick conversation with somebody the other day. They were saying, what's the MLS for the commercial side? I was like, I don't know, but it sounds like there is none. So
there's not. CoStar is the closest one, but it's just a guessing game.
So it's all about relationships then. And right?
Mhm.
At a certain point, that's really your only shot, is if if they're going to share
Like
with
an
you.
honor system.
Yeah, there are a lot of commercial brokers that have a lot of knowledge, and they all talk to the other brokers. And if you are a commercial broker, it is based on relationships. But like if you've been in business long enough, you can kind of call the other brokers and say, hey, what sold recently, at what price, who bought what. And the other thing too that's different that was a bit of a learning curve is on the residential side. Typically, one person will buy one investment property. They might be 2 or 3 or 4, but on the commercial side, there's a few groups that own, billions of dollars of real estate. So you might have one owner that owns, a whole section of town or like tons of properties. So they have a lot of their own data that they know. And so you can talk to that one person and they'll give you a ton of data just based on their inventory. So that's been a learning curve, is to figure out, okay, well, there's only, maybe 500 owners that I could target that I could potentially buy a property from in my selected region, which is Dallas to San Antonio, with the type of buy box that I'm looking for. So that's not a whole lot of people that, so I got to, have a good reputation, maintain relationships with all of those people. And, maybe I'll buy one from someone one day and sell it a different building to that same person later on.
Sounds like we need to go start a city somewhere.
What a great idea. It would solve so many problems.
So one of my questions, and this kind of applies to everybody, but obviously you're our guest, Ryan, so I want to ask you first. What is your favorite source of knowledge when you're looking to learn more about what you do?
Definitely mentorships have been where I've had the most growth personally. I have a construction partner who owns his own construction company, and he's been doing it 25 years. I'm part of these mastermind groups. So I was part of Wheelbarrow Profits, recently joined GoBundance. There's a few others out there, like Tiger 21 is once you get to, super high net worth, you can join that one. And, between these mentorships and these mastermind groups, they've got Facebook communities and they've got WhatsApp chats and Slack lines that anytime you need a connection to a vendor or you have a problem that needs to get solved and you say, hey, what have you guys done in this? Or, hey, let's all just kind of collaborate and figure out how to solve this problem together. It costs money to join these, but the way that you can accelerate your knowledge and your resources grows vastly faster with that group. And so it's always been worth the cost every time. So I'd say, the combination of someone local who's been doing what you've been doing for, 20 plus years, that knows exactly where you are and what the next is, super valuable. But then around a community, and some of these are, either local or national, but just people that are all at your stage of life that can, kind of help crowdsource what the answers are.
It's great answer. Circles of trust.
Absolutely. Real estate's such a relationship game. The longer that you're in there, at least the good people that stay in it a long time, it's because of relationships.
JJ, Randy, what do you have?
Regarding knowledge?
Sure.
I think I agree with Ryan. I think people straight up are the best because it beats like ChatGPT because you could have like a real conversation. But
ChatGPT is awesome, but okay.
Yeah, but I do think it's super expensive. Like some of these groups are like thousands, like tens of thousands a year.
10,
right?
20,000. Yeah.
It's still good. I go with books. For the way I look at it, you could get an 8-hour audio book for like $20, $30, or $20-$30. And if it's the right book, it builds on the information because it's kind of better than a podcast. It's like chapter 1 is like basic arithmetic. By the time you're at the end of the book, it could be like calculus if you get like the right book. So I like that build up for, $40, and you get 8 hours of some smart author, like straight up.
I think
books are like the slow version of ChatGPT.
Yeah, it's just on the speed. You read the books. Yeah, you apply it to your own situation. Some of these groups, I've read books and then I joined the group and I was like, oh, you're the author. Like, I know your name. I read your book.
Oh, wow. That's really
You
cool.
know, so you get to ask the author directly. But, you know, obviously there's a cost to that, right? And, you know, you're limited on how much of a resource you have. So,
Or maybe like lobster dinners with the book authors, because then it'd
there
be
you
like
go.
$100, but you get like
That would
a
be
good
incredible.
interactive hour.
One of the things that I've learned that's been very interesting, when I was doing mortgage loans and just general real estate, a lot of deals were closed over phone calls. You know, if you had a really good sales pitch and you could tell a good story over the phone, or even little Zoom calls, you know, that was a way to build enough trust to get a deal closed. But in commercial, a lot of the deals are done over the dinner table, over happy hours, over get-togethers. It's so much more of an in-person activity because these are, you know, tens of thousands or millions of dollars of transactions. They don't, you know, they're not just going to go with a person. They say, well, yeah, you might have offered on our property, but like, do I know that you're going to be able to close? Do I know that you're the right buyer for this property? I want to get to know you. And so it's a much longer sales cycle, and it's a much more intimate setting of getting to know each other. So that's been an adjustment period where I've had to change, like, okay, instead of just, you know, making 100 phone calls a day, now I got to say, how many dinners and how many lunch appointments can I do where I can have the relationships with people per week?
I had another question based off of that. So let's say someone's about to invest like 100,000 with you, right?
Mm-hmm.
But then they had all these questions about like, who's your asset manager? Who's your property manager? Like, are you using whatever commercial agent?
Mm-hmm.
Like, how does that nurture look? Do you have a bunch of Zooms? Do you have a bunch of dinners? Do you do like presentations for everyone interested?
Sure. Well, you know, I'm easy to get a hold of. You know, my website's topproducerinvestmentcapital.com. I've got my phone number and email on there. If anybody wants to reach out, they can schedule an appointment with me. But for the specific property, when we have an investment come up, we'll go under contract. We'll send out an email. We've got, you know, 1,200 investors in our database. And so we'll say, hey, here's the next opportunity. Here's all the material. Here's everything that you would need to know to make an informed decision on this deal. And then we'll host a live webinar. Webinars are usually about an hour long. So the first 40 minutes, we're going through our opinion on, you know, the prospectus of the investment. And then we open up 20 minutes for questions. A lot of the times the public questions, somebody else thinking the same thing as someone else. So you ask it publicly and it gets answered. But, you know, like all that stuff, you know, I usually have my cell phone on me. You can give me a call anytime, schedule a call, do an email, any further follow-up. So it's, you know, because we only have, I mean, it is a lot of money, but each deal we have, you know, I think the largest, we had 61 individual investors. So, you know, I can have 61 conversations a week pretty well if anybody ever wants to.
Yeah.
Just wanted to give a shout out to Lee. Sorry, my internet was lagging a little bit, but Lee says, hi guys, what's the topic today? Lee, we're talking about multifamily syndication. It's been a very, very good conversation. Ryan has brought some incredible knowledge for us. So it's really great.
This would be, I know that's my client and friend from California, and this is right up his alley. So hopefully he takes a moment to rewind, and you should watch what Ryan said, Lee. I think you would like it.
Yeah, I'd have to study the transcription.
What?
Randy, you just said rewind. You just said rewind.
You can rewind on YouTube. You go back. Yes, I rewind on YouTube a lot, so clearly you can see my habits on YouTube.
You can rewind on YouTube.
Yeah.
We're not talking about VHS tapes.
What? There's not another word for that.
Like click back.
Okay.
I would actually look at this transcription and kind of. I think there's also a lot of terminology you threw out, like IRR, and kind of understanding what all that is also important because you're buying shares in an investment. There's a lot of vocabulary there.
Yeah, the comment for Tiger 21. Yeah, it's $10 million if you want to join that one. So that's a big boys club for sure.
Ooh,
What's that?
nice.
So like some of these other groups, their mentorship, that one's also based in philanthropy. So in addition to just being around other wealthy individuals, they are structured in helping give back to the community in some philanthropic ways. They do fundraisers for charitable organizations or, you know, good causes. So
is that a local group?
I'm not sure. I want to say it's national, but it could be.
There might be like a chapter. EV 130. We'd like to
I mean,
hear
it
more
says
about
Northwest. I'm thinking, okay, just the Northwest. They must have at least 4 here, right?
It means net worth on there. NW net worth.
Oh, got it. 10 million. Okay. Yeah. It's good. All right. Well, it is 2:59. The Austin chapter. There is an Austin chapter. 33,000 a year membership. Got it. So it's the net worth. Okay.
That
Cool.
might be
That's
Justin
the
Donald.
group.
They're like an investment club.
He'll be
Justin
calling
Donald.
himself out, man. That's the thing. He wanted to be discreet about it. You know, that's the way of the internet these days.
It's exclusive stuff.
We're in Texas.
Maybe
Something
other
privacy.
recruiters.
Anyway, yeah. Well, anyway, thank you very, very much, Ryan. Randy or JD, do you have any last words or closing thoughts
that was
for
a
Ryan
really
or for anybody
great
else that's watching?
discussion. Thank you very much for being here, Ryan. That was a lot of really great information.
It was.
So certainly couldn't have gotten it from the three of us. So.
Yeah. Appreciate you, Ryan. Last words. Rewind this.
And rewind so that you can hear what he says.
Awesome. Thanks so much for having me on, guys. I really appreciate it. It's great to roundtable and share knowledge like this.
I love it, man. Thank you. Everybody, take care. Have yourselves a good one.
Bye.
Bye.